Hey there, and welcome to the College Investor Audio Show. We're so glad you're hanging out with us today as we take a look at income-based repayment plans. They are a-comin' to private student loans. Before we get to it, just a reminder that anytime you hear a topic discussed on the podcast, you can always see the article and dive really deep into everything about the topic inside the article at thecollegeinvestor.com. You can also ask questions, get to know us, because we'd love to help you along wherever you are in your money journey. Just follow us and like us and all the things on social media. Search for The College Investor and you'll find us. All right, let's take a look at this now. For years and years, income-driven repayment has been a dividing line between federal and private student loans. Federal borrowers could tie monthly payments to income, but historically, private borrowers just couldn't. That line is starting to blur, though. RISLA, Rhode Island Student Loan Authority, a nonprofit student loan lender, based in Rhode Island, in case you couldn't guess, has introduced an income-based repayment or IBR option for borrowers who refinance their student loans through the organization. The plan borrows heavily from the old IBR framework, which was created way back in time to 2009, offering payment flexibility during periods of lower income and forgiveness after decades of repayment. Okay, so it's a small, granted, but notable shift in a private lending market that has traditionally emphasized fixed monthly payments and faster payoff schedules. As federal student loan policies continue to change, and we do follow those, you can follow along at thecollegeinvestor.com. The question is whether other lenders are going to follow and whether borrowers should welcome them if they do. So here's how RISLA's income-based repayment works. Under the new IBR program in Rhode Island, borrowers who refinance their student loans can cap their monthly payment at 15% of discretionary income. That payment will never exceed what the borrower would owe under a standard repayment plan, and the minimum payment is just $10 per month. However, if there's a cosigner on the loan, this is a big deal. Kind of appears that both incomes, the borrower and the cosigner, will be used to calculate the payment amount, which could be a big deal there. Interest continues to accrue during IBR periods too, but there's an important guardrail here. Unpaid interest does not capitalize, meaning it does not get added to the loan balance until the borrower reaches the end of the IBR repayment period. That's good news. Borrowers who remain in the program for 25 years of qualifying payments can receive forgiveness on any remaining balance. Periods of forbearance or deferment do not count toward the total, unless the borrower is actively making IBR payments. RISLA also says borrowers who enroll in IBR remain eligible for its profession-based loan forgiveness programs, including nursing rewards and internship forgiveness. That combination is very unusual in the private market, as most other private lenders don't offer forgiveness programs at all. Here's why private lenders are experimenting right now. Private lenders have long avoided income-based repayment just because of its uncertainty, right? Fixed payments make loans easier to price, easier to securitize, and easier to explain to investors. But the student loan market is changing rapidly, rising balances, uneven wage growth, and the normalization of income-driven repayment in the federal system have kind of reshaped borrower expectations for many years. A lot of borrowers just see payment flexibility as kind of a baseline feature, not a luxury. So from a lender's perspective, IBR can serve as a risk management tool. A borrower who can reduce payments during a job loss or income dip might be less likely to default. Lower default rates can offset the cost of longer repayment periods and potential forgiveness. RISLA's nonprofit status is going to help to make the math easier, too. The organization does not answer to shareholders in the same way large for-profit lenders do, giving it more room to prioritize borrower stability over short-term returns. So what does the math look like anyway? All right. A little bit of number crunching, but it won't be too bad, I promise. Income-based repayment lowers monthly payments, but it almost always raises the total amount paid over time. Time is a huge factor in student loan repayment. So consider a simplified example here. Loan balance, $60,000. Interest rate, 6%. Borrower discretionary income, $50,000 per year. We got our numbers. Now, here's a standard repayment, which would be over 15 years. A borrower on a 15-year fixed plan would pay like $505 per month. Yikes. Over 15 years, total payments would come to about 91 grand with the loan paid off in full. Shorter repayment plans repay even less due to less interest accruing. The income-based repayment, which would spread that out to 25 years. At 15% of discretionary income, the monthly payment would be $343 per month initially, but payments could rise over time. In fact, the lender is betting on it, by the way. Over 25 years, the borrower could easily pay 100 grand in total, depending on income growth, before any remaining balance is forgiven. It's also important to realize that forgiven balances are taxable. And there could be a potential student loan tax bomb at the end of the whole thing. The borrower does benefit from flexibility and protection against unaffordable payments, and the lender would benefit from extended interest collection and lower default risk. The trade-off is time. Here's what this means for borrowers. For borrowers with volatile incomes, early career professionals, gig workers, those entering lower-paying public service roles, etc., private IBR could reduce financial strain, at least initially, without forcing them back into the federal system. However, and this is a big however, those with volatile incomes might find it difficult to be approved for a refinance into an IBR program. There are multiple student loan refinance lenders, and they all have different underwriting criteria. If there's repayment risk, they're not going to offer IBR. Probably. Refinancing into a private loan with this IBR plan also means giving up federal protections like public service loan forgiveness and any future federally mandated payment pauses. Kind of too early to call this a trend. It's just one lender moving, but we're going to watch that move closely. If default rates fall and borrower satisfaction rises, other lenders might test the similar options, possibly with stricter eligibility rules or even higher interest rates to offset that risk. But we'll follow it, and you can follow along with us, too. Get up-to-date info every time we receive it at The College Investor. Just search for those words on social media, and you'll find us. You can also always find so many articles, resources, links, and everything you could possibly need to know about any topic we talk about on the podcast at thecollegeinvestor.com. Thanks so much for stopping by today, and we'll talk to you again real soon.